Hey everyone, welcome back to Corporate Decoder, the place where we dig into the financial reports of companies so you don't have to. Today we're looking at NextNRG, and it seems they're playing a high stakes game of financial maneuvering that might just leave them running on fumes. This report is about a few deals they made to get some quick cash. It involves selling future earnings for money now, and it also involves the CEO putting his own money on the line. Let's break it down and see what's really going on. First up, NextNRG made a deal with a company called Redstone Advance. Basically, NextNRG is selling a portion of its future sales to Redstone. They're calling these future sales future receipts. Redstone is paying NextNRG only gets to keep $1,516,000. For this, NextNRG is selling to Redstone proceeds of future sales made by the company, collectively the future receipts, in the amount of $3,217,700. Think of it like this. NextNRG needs money now, so they're selling their future income at a discount. It's like a payday loan, but for a company. To pay Redstone back, NextNRG has authorized Redstone to take out $125,000 every business day from a bank account. The idea is that this amount represents 20% of NextNRG's future receipts. But if NextNRG's actual revenue is different, they can adjust this amount. Here's a key point. Michael D. Farkas, the CEO and main owner of NextNRG, personally guaranteed this deal. That means if NextNRG can't pay, he's on the hook. This shows that he has a lot of confidence in the company, or maybe he's just really desperate. Next, NextNRG did a similar deal with another company called Mr. Advance. Again, they're selling a portion of their future sales, this time 7.54%, until Mr. Advance gets the purchased amount. The amount is $2,965, and the amount NextNRG receives after fees is $1,515,965. Like with the Redstone deal, NextNRG has authorized Mr. Advance to take out $125,000 weekly to cover that 7.544% of their expected future receipts. And guess what? Mr. Farkas, the CEO, also personally guaranteed this deal. So he's now personally liable for two of these types of agreements. But wait, there's more, because Mr. Farkas is personally guaranteeing these loans. NextNRG is paying him a fee. This is a fee agreement. The company agreed to pay Mr. Farkas a fee in the aggregate amount of 3% of the funds personally guaranteed by Mr. Farkas. So the company pays him 3% of the total guaranteed money. Think about it. NextNRG is paying their CEO a fee because he's taking on personal risk to help the company get money. It's a bit of a circular situation. Finally, the company released a press release announcing some unaudited financial results for February from their Esville mobile fueling division. Basically, this is probably some good news they want to share with investors. Let's talk about what we've just seen. NextNRG has basically sold a significant chunk of its future income to get cash now. They've done this through two separate deals, and their CEO has personally guaranteed both of them. They're also paying the CEO a fee for doing so. The question is, why? This kind of financial maneuvering is usually a sign that a company is struggling with cash flow. They need money now, so they're willing to sacrifice future profits to get it. It can be a risky move, because if they don't generate enough revenue in the future, they could default on these agreements, which would be very bad. The fact that the CEO is personally guaranteeing these deals is also interesting. It shows that he's very invested in the company's success, but it also puts him at significant personal risk. If NextNRG fails, he could lose a lot of money. And what about that fee agreement? Is it fair for the company to pay the CEO for guaranteeing these loans? Some might see it as a necessary incentive to get him to take on the risk. Others might see it as a way for the CEO to extract more money from the company, especially if the company is struggling. It does seem weird though, and raises eyebrows. Here's my take. NextNRG is in a tough spot. They need cash, and they're willing to take on a lot of risk to get it. The CEO is putting his own money on the line, which shows he believes in the company, but these kinds of deals can be dangerous, and they could backfire if NextNRG doesn't turn things around quickly. One major risk is the high cost of these agreements. Selling future revenue at a discount plus paying fees to the CEO significantly reduces the company's potential profits. Also, reliance on CEO's personal guarantees highlights a potential weakness in the company's financial structure. What happens if he leaves or is no longer able to provide such guarantees? And despite these risks, a potential opportunity lies in the Esville division if the financial results is good news, as they mentioned in the press release. This could be a growth driver that helps NextNRG meet its obligations. In conclusion, NextNRG's latest moves are a mix of high risk and potential reward. It will need strong execution to avoid financial trouble. Thanks for watching Corporate Decoder. If you found this analysis helpful, please like, comment and subscribe. Let me know in the comments what company you'd like me to decode next.